All right, so we are at the end of chapter 14. We're talking about long-term financing liabilities, and let's just go through the learning objectives, make sure that we've covered everything, and then we'll get to our final subject here. Um, Remember, we talked about the reasons for issuing long-term financing instruments such as bonds and notes payable. One thing, companies going to make a decision between issuing equity securities or debt securities in order to get the resources necessary to purchase assets. And so when we think about that, why would you want to issue debt versus equity? And some of the reasons we talked about is that debt is cheaper because of the tax deduction. Debt is cheaper because it's less risky than equity, so creditors don't ask for as much because of collateral issues and things like that. We also talked about the fact that you don't have to give up ownership interests, voting rights. And then we talked about the big issue being financial leverage. And that can really be a big benefit as opposed to issuing equity. We also talked about the characteristics of bonds and what we talked about there with respect to, whether they're mortgage bonds or debenture bonds. We talked about term versus serial bonds. We talked about, variable rate interest versus fixed rate. And, for our purposes, we've been mostly just doing some basic straight debt securities, term bonds, etc. And, right, you really have to be able to do this. You have to be able to compute the issue price of a bond payable. You have to record the issuance. You have to be able to amortize bond discounts or premiums. Those are going to be a must. You're going to have to do that for the exam. You're also going to have to explain the extinguishment of financial liabilities, basically retirement, through a call provision or just deciding that you're going to retire those bonds. Bonds with equity characteristics, there's two, right? There's convertible bonds that get converted into equity securities. We did a problem like that. And we also have bonds with detachable stock warrants. In both cases, with bonds with conversion feature, remember there's two types. The convertible bonds, we don't account for the equity characteristic up front. They're just treated as normal debt. However, if the conversion feature can be settled in cash, then we'll account for the debt and the equity feature. With detachable stock warrants, we're going to account for the equity feature up front. We're going to allocate a portion of the proceeds to stock warrants, and we'll do it either on the proportional method, if both fair values are known, or the incremental approach if only one of the fair values is known. We talked about long-term notes payable, three types, right? When it's issued for cash, usually at a discount. When the long-term note payable is issued for cash plus some right or privilege that we've provided to the creditor. And then long-term notes payable issued for assets or other equity or whatever. In those cases, what we have to do is we're going to account for that long-term note payable at the fair value of the asset received or the fair value of the note payable. And then we'll talk about the disclosure of long-term notes payable and of long-term financial liabilities and understand troubled debt restructuring. So that's really where we are. So let's get to that slide. And when we're talking about the reporting of long-term debt, long-term financing liabilities, debt, bonds payable or notes payable, we have to talk about the nature and the term of the obligation. So what's the maturity time, and what is the nature of it in terms of fixed versus variable, interest rates or whatever. When's the maturity date and all those kind of things. The total amount of the fixed and determinable portion of the obligations at the balance sheet date. So how much is coming due this period, and then how much is coming due each of the next 5 periods. The third thing that has to be provided is the nature of any variable portions of the obligation. So normally, what we've been doing here is we've always been talking about fixed stated interest rates. Sometimes the interest rate may be a variable interest rate tied to some index like LIBOR, London Interbank Offering Rate. So as that rate changes, as that index rate changes, you may have to pay more or less interest. and that goes into this variable portion of the obligation. And then also the amounts reacquired or settled under the obligations for each period for which an income statement is presented. So those are the things that need to be reported about the long-term financing debt. But now let's get into the main subject here, which is accounting for troubled debt. And in this case, we are going to talk both from the debtor's perspective and also from the creditor's perspective. So we're talking about both sides of these transactions. And when we talk about the creditor first off, and this is the major issue, they have this impairment issue. So the big question for the creditor is, when is the asset, because for the creditor it's a loan receivable and interest receivable, when is it impaired? When do they think they're not going to get the money back? And the key here is that a loan receivable is considered impaired when it is probable, based on current information and events, that the lender will be unable to collect all or part of the amounts due, whether it's principal or interest, according to the contractual terms of the loan. If the loan is considered impaired, so if you're in that second step, how do you calculate the loss? The loss due to impairment should be measured as the difference between the investment in the loan, basically the asset today, and the expected future cash flows, discounted at the loan's historical effective interest rate. And this is the key. So we may have a new change in the stated rate, but we always want to use the effective interest rate that was in effect when the loan was initially provided. And in this case, right, at this date when it becomes probable, there's no debtor recognition until there's an actual modification of terms or if the debt is settled. So we'll come back to this in a little bit, but this is a key issue, is that we're not going to have comparable accounting for the debtor and the creditor in these situations. So this is the one where we have a situation, and we're going to do an exercise later on. This is exercise 27, but this is where we settle the debt at less than the carrying amount. And for the debtor's perspective, you actually have a gain equal to the difference between the amount of the liability today, the debt, and the fair value of the assets or equity transferred to the lender. Right? So pretty straightforward. You have a liability today, no payable, interest payable, and you're going to settle it by transferring assets or equity. The difference between those are going to be a gain. For the creditor, right, the debt's settled, it's extinguished, and for that case, right, we're going to remove the liability from the books, and we're going to recognize a normal loss equal to the difference between the loan receivable, the asset, and the fair value of the assets and equity received. Right? Hopefully, what's happened is previously there's been a loan impairment. You've recognized that loss and you've set up an allowance for doubtful accounts. Now when it's actually settled, you would reduce the allowance for doubtful accounts for the difference. If there was no allowance for doubtful accounts, you would just recognize the loss at that point in time. So normally impairment happens before the debt is settled or modified, because right, you're supposed to be looking forward, and if it's probable that you have a loss, you should recognize it at that time. And then when it actually happens, right, that's when you would reduce that allowance. More importantly, though, this is the case that makes the accounting for troubled debt restructurings more difficult. And a restructuring occurs when the creditor, for economic or legal reasons related to the debtor's financial difficulties, grants a concession to the debtor that would otherwise not be granted. And normally this is a modification of terms, and it might be such things as a extension of the term. It may be a reduction of principal. It may be a reduction of the interest rate. Right? And remember, for these modifications, we have to be really careful about how we calculate um, the debtor's position versus the creditor's position. All right, so um, both the debtor and the creditor are going to account for the modification prospectively, obviously into the future. And this is the key. Let's talk about the debtor first. If the carrying amount of the debt at the time of the restructuring is greater than the undiscounted total future payments to be made, the debtor recognizes a gain and the creditor a loss. Right? And the gain is equal to the liability minus the sum of the undiscounted future cash flows. The key is that no further interest expense is recognized on the debt. All additional cash received is treated as a reduction of the reduced liability. All right, so we'll go through an example of this, but let me just kind of give you a flavor of what's happening here. So imagine that today uh, the bank is owed $10,000 plus $2,000 accrued interest. So from the debtor's position right now, they have a liability of $12,000, and they cannot pay that amount. And so the bank says, what we'll do is we will extend the term of this agreement 2 periods, and we will reduce the principal amount from $10,000 to $8,000. All right. And in addition, we'll reduce the stated rate to 5%, and we'll forgive accrued interest. So if this is the case, right, the current liability equals $12,000, and the amount that we're going to have to pay back to the bank is, right, the interest payment of $400. That's the 8,000 times 5% each period, plus 8,000. So we have a liability today versus, right, $8,800. So not discounting, right? So we just took the undiscounted amounts, and that difference, because the undiscounted future cash flows are less than the current liability, we will recognize a gain equal to $3,200. And we would write down our asset today, our liability today, in the amount of $12,000 down to $8,800. Now, the liability is now at $8,800. When this is paid, it's simply a reduction of liability. No more interest expense is recognized. No more interest expense is recognized. And every payment is simply a reduction of that liability going forward. Now, that's the easier case. The harder case is if the carrying amount of the debt is less than the undiscounted future cash flows, no gain or loss is recognized up front, and the interest is going to be continued to be recognized, although at a newly calculated effective interest rate. So here's the same situation. We still owe $10,000 today plus $2,000 of accrued interest. So our liability today is $12,000, and the bank is going to extend the term 3 periods. They're going to lower the principal amount to $9,000. The stated rate will be 10%, and so we'll have to pay back 900, 900, 900. Right. So this is the more difficult situation where we have to not recognize the gain from the debtor's perspective. So if the carrying amount of the debt today is less than the undiscounted future cash flows, no gain or loss is recognized, and a new effective interest rate is recognized. So imagine that we're in a situation where we owe $20,000 today. So that's our note payable, plus $1,000 of accrued interest payable. So we owe $21,000. That's our liability today, and we can't pay it. And the bank says, okay, so because you can't pay it, we'll extend the term 3 years. What we'll do is we'll reduce the principal to $18,000. You only have to pay back $18,000, and we'll reduce the stated rate to 10%. And so you'll have to make a payment of $1,800, and $1,800 over that time period. And so we look at that, right? $1,800 plus $1,800 is $3,600 plus $1,800 is $5,400 plus the $18,000. Well, over that time period, we're going to have to pay back $23,400. And so the key here now is that we're in a no gain situation. What we have to figure out is a new effective interest rate in order to basically equate those future payments to the present value of $21,000. And so N equals 3. The payment is going to equal negative $1,800. The future value is going to be negative $18,000. And the present value equals positive $21,000. And I want to solve for my new effective interest rate. And so I'll punch this into my calculator. N equals 3. 1,800 is my payment. 18,000 is my future value. 21,000 is my present value. Solve for interest rate per year, and I get 3.995%. And that's going to be my new effective interest rate. And I'll use that, right, in order to reduce down that liability of $21,000 currently to $18,000. And let me just show you that. So I'm just going to combine these two accounts. I'm going to say liability equals $21,000, right? And on my first interest date, 12/31, I know I'm going to pay cash of $1,800. And right, what I know is that this liability after those 3 interest dates has to end up at $18,000, how much I'm going to pay. So I'm going to be making amortization entries here. And remember, my new effective interest rate is 4%, and so my interest expense is the 4% times $21,000, which is $840. And so my liability is going to be decreased by $960. And right, I'll have, after that point, I'll have a new carrying value. My carrying value after that date will be $20,040. And right, I'll do 2 more of those. I'll end up at $18,000. So I still recognize interest expense when And so now, as we go forward with this, we're only going to recognize interest expense at the new effective rate. We'll end up down at the liability of $18,000, and we'll be set. All right, so that kind of finishes up accounting for impairment of notes and bonds payable, and we should be set for the exam.